Thank you very much, and thank you everybody for your time today, and thank you Nidhi for your presentation. Look, the objective of my session today really is to talk to some of the same sorts of decision-making biases, behavioural biases that Nidhi has touched on in hers, but in particular to put an Australian lens on it. So in that context, to sort of reflect on some of the conversations that I have with my clients who are Australian super funds, who are fund managers, research houses, financial advisor groups, in the Australian context as they think through some of these issues and try and think through some of the solutions for them as well. You'll see the title for my session there is Leaving Bias on the Bowling Green. And I didn't realise Nidhi was going to have a bowling scenario in her session as well. But in my case, it's lawn bowls that was the connecting point. And you might say, well, what's lawn bowls got to do with finance and behavioural and decision-making biases? What I was trying to do with the lawn bowls analogy here is to think, well, how do I connect the ultimate objective of our industry to meet the retirement goals of our members and ordinary Australians? How do I connect that with some of these ideas around decision biases? And of course, as you know, lawn bowls is an icon of Australian retirement. More than 500,000 people play lawn bowls every year. And for those of you who know about lawn bowls, you've got to bowl the ball, try and get it close to the jack. And if you bowl that ball straight down the middle, you'll end up being one side or the other. The bowl itself has a massive inherent bias. So what you need to do as a successful lawn bowler is you need to understand that bias and then adjust for it. So if you understand and adjust, you can get the bowl to curve around and end up where you want it to. So here is the analogy, I guess, for decision-making biases. What I'm going to suggest to you for this session is that we are actually quite similar. We have these inherent biases. What we need to do is take a lesson from the lawn bowler and actually adjust for it like they do. There's a clicker. Where do I point this thing? There we go. Okay, so what are we going to cover today? Well, there's a bit of a summary there, but to be honest, this is a half-day workshop I've compressed into 20 minutes, so hold on to your hats. I'm going to run through it reasonably quickly. So I'm going to talk a bit about what some of these biases are. We're going to talk about some of sort of the issues and challenges, some of the things that come out and emerge in the conversations that I have, and then talk about some of the barriers and potential solutions. Now, I know Nidhi's got a paper that she's written that talks in more detail about some of the concepts that she has spoken to today. Same for me as well. So I suggest that you're interested in more detail, go and have a look at those papers, which should be available on the ASFA website, if not already. I'm getting a nod down here. Are they on already? They are. Perfect. Okay, so how do we think about this sort of stuff in the Australian context? So my reflection on this is that really there's two buckets. The responses I get when I talk to my clients around this sort of stuff is there's a sort of a comfortable or obvious sort of way where the conversation sort of tends to start off, and then there's perhaps a less comfortable and less obvious way. When I talk about behavioural biases, I think where the conversations tend to go is towards this stuff applies to members and this stuff applies to markets. So with members, we've all seen, we've discussed at some length in other sessions that members are going to be biased, they're going to be influenced by what they see in the paper and what they've heard around the barbecue. There's a whole bunch of things they're going to do. Certainly, I agree that's true. And then markets. So markets are prone to big swings and irrational exuberance and fear and greed and all that sort of stuff. And if you dig into a bit more detail, then actual behavioural effects underpin momentum and value effects and under and overreaction. There's a whole lot of implications for markets. Now, I think those two things are really important and significant, but I think what is more overlooked is what's in that right-hand box, and that's where I'm going to focus my attention for this session as well. Because what happens on the left is we're talking about somebody else. It's much easier for us to talk about the biases of somebody else. It's not so confronting to think that maybe my decisions actually might be affected in these sorts of ways. What the research shows, and we'll dig into it in a bit more detail as we go through, is that actually none of us is immune. Even the people who have spent their whole lifetime studying these effects and trying to overcome them are unable to do them in many cases as well. And then in particular, the last one there are interactions. So we've got a number of different people who are making decisions in different parts of the value chain across the industry. And some of these biases are interacting and offsetting and influencing each other as we interact throughout the value chain. So as an example, you might find that, well, maybe investment professionals, as they're designing a portfolio, might be biased in the way they create the portfolio. Maybe that leads to a worse risk-return profile of that portfolio. But then if that means that the member likes the portfolio and sticks with it through to retirement, maybe overall it's a better outcome for the member. So I'll challenge you to think as we go through, not just about the left-hand side, but the right-hand side as well. So what are all these biases then? Well, the challenge, I think, when you look at the literature is there are so many of them. As Sam pointed out at the outset, there's a lot of them now. There's more than 150 have been empirically studied in the psychology and behavioural finance literature. So what do you do with 150 different individual biases? Well, it's a challenge. So what I tend to do when I talk to people about this sort of stuff is try and group stuff together into manageable groupings of biases that are sort of roughly pointing in the same direction, roughly having the same sort of implications and impacts. So I've created these things called behavioural clusters, these groupings of underlying biases. Now, there's a fair amount of nuance and detail in each of the biases, each of the clusters, I should say. But I'll just give you a bit of a snapshot as we go through so you get a bit of a sense of some of the things I'm talking about, and then we can go through to some of the implications. So, cluster number one, consistency. So this is the idea that we like to be consistent, and we like to be seen to be consistent. Now, you might think, well, that sounds fine. I don't like to be inconsistent. That sort of sounds rational, and there's no problem with that. But what the evidence shows is that we can sometimes be consistent at the expense of being accurate. So a good example in the investment space is you've made an investment decision. It was a good one based on the information you had available at the time, all things considered. It's a fully rational view. But things haven't worked out quite the way we've intended. This thing now, the share price has fallen or something's gone wrong with the investment. We're now at a second decision point. We're thinking about what we're going to do about that. Now, the fully rational view would say at that point, okay, let's consider all the information again, work out whether it's still something we want to hold on to, let's make another fully informed rational decision. However, what the evidence shows is that we tend to want to be consistent with our original decision. We tend not to actually reconsider this. We're going to tend to hold on to this one longer than perhaps we should. Actually, I had a good example of this the other day when I had an analyst from a research house in one of my sessions, and he said, yeah, Simon, but you don't want to be selling this sort of thing. You don't want to be seen to be capitulating. And I think it's a great example that because we're so strongly averse to breaking this sort of consistency bias, that we've actually labelled this thing with a fairly emotive term, which is capitulation. And yes, if you label it capitulation, nobody wants to do that. But actually, we want to break away from that and make a fully rational decision. The second one there is overconfidence. So in a nutshell, this means that we underestimate uncertainty. So this conference, we're talking about how do we deal with uncertainty. What the evidence shows is that when there's this much uncertainty that we're dealing with, we tend to think it's only this much. This one's very easy to demonstrate, and it's quite amusing. I even tricked Sam with a question on this one yesterday, which I was quite happy with. But this is partly also the idea that this is sort of the above-average driver effect. So everyone, well, 80, 90% of us think we're above-average drivers. Well, when you look at the large-scale surveys of fund managers, for example, 75% of fund managers are above average compared with other fund managers. I'm guessing the 25% are just average rather than below average. So what does it mean if we're overconfident in our decisions, underestimating how much uncertainty there is? Well, we can make too many active choices. We can, for example, be trading too much turnover in the portfolio, which has obviously got substantial cost and tax consequences for different member types. Number 3 there is anchoring. You're probably familiar with the idea of anchoring, that a number that's inserted in our sort of conscious awareness as we're thinking through a decision can drag our estimates of value upwards or downwards towards that anchor point. Again, very easy to demonstrate in sort of a workshop environment. I can effectively drag people's view of value by 50, 60% in many cases. It's a very powerful and well-documented effect that applies to us all. So what's the implication of this one? Well, again, it actually compounds the idea that we might hold on to losers too long. This is one of the best well-documented effects. If I've bought at a purchase price here and it's now dropped down, well, that original purchase price is likely to act as an anchor to drag my estimate of value up towards it. But there's anchors all over the place in our industry. Number 4 there is social. So when we think about the sort of easy to think about sort of left-hand side of that previous slide, which was the members and the markets, we can think of the barbecue conversation for the members. We can think of herding and sort of some irrational group-type behaviour in markets. But when we think about how it applies to us and how it applies to the interactions we have in our industry, and we start looking at things like the inherent sort of group biases in group decision-making. Cass Sunstein in his session, the leadership session, which happened on Tuesday, which I know some people who have attended would have gone through this in a great deal of detail. But to summarise a lot of his years of work in like one sentence, it is that groups can often accentuate, can often amplify some of the underlying biases of the individuals in those groups. Now, a well-functioning group can overcome it. The well-functioning group can actually lead to better outcomes, but often we are not. And so there's some real issues there for anyone who's making decisions in the context of a board or an investment committee or other group decision-making frame. Number 4, loss aversion, which I know Nidhi's touched on, and also I think Cass Sunstein, so I won't mention too much, other than the broad concept here is that we fear losses more than we should. And again, you think, well, losses, they're a bad thing. Yes, I want to avoid them if I can. But the expense of sometimes avoiding losses is giving up some upside, particularly if things are weighted in our favour. So some examples there might be, well, how do I go about avoiding losses? Maybe I just don't sell my losing investments. I haven't really realised it. It's not really a loss. How do I avoid losing relative to benchmark? Maybe I just minimise my active share, then I'm less likely to underperform. How do I minimise the risk of underperforming relative to peers? Maybe if I do the same thing as my peers, they're less likely of underperforming. So we're taking away the downside, which we fear, but we're also giving up some of the upside as well. And then framing. So Michael Drew, this morning was talking a bit about the importance of framing. The idea here is how we frame a question, how we frame a decision makes a big impact on the answer that we get to. So our frames of reference here, and I think Nidhi's touched on some of these as well, clearly the benchmarks we use, the asset class definitions, the geographic boundaries, so the style boxes, all these sort of definitions, do they have an impact on our decision making? Well, yes, they do. The research shows that these sorts of things are very powerful determinants of the decisions that we come to. Are they the best frames of reference? Are there alternatives that we could use instead? I think the answer to that is that yes, there are. So you can look, for example, at factor-based views of risk and return, which will look through geographic boundaries, which will look through sort of asset class definitions. Or as Michael Drew was talking about before, if you take the member lens and take that frame of reference, then you start to see the difference between the time-weighted returns and money-weighted returns and outcomes ultimately for members. And finally, emotion, which is sort of a grouping of these sort of subconscious biases. We saw the picture of the iceberg, which I think is a very good representation of some of this sort of stuff. About 80% or so, 85% of our brain actually operates in the subconscious regions. The emotional stuff sits in there as well. So we're not sort of directly aware of what's going on in some of our mental processes. But what the research shows is that emotion is a key driver, not just for members, not just for markets, but for a lot of people, a lot of investment decision makers. Now, we can overcome emotion in many cases, but it takes effort. It takes concerted effort and control. And what that means is that it leaves us vulnerable at times of stress, at times when we might have information overload, or sort of short time frames to respond to things. So that speaks to things like reporting season, for example, when there's a lot of information. It speaks to papers that might be circulated to trustee boards and making sure that there's enough time to digest them to help overcome some of these issues. All right, so I'm going to turn next to, well, what does all this stuff mean? Is this stuff important? But before I do, I've got a little quiz for you. So this is a behavioural finance quiz. And the idea here is to try and see if you can pick who said these things. So the first one, to give you a clue, is based in the US. It's a gentleman who was asked about how he allocated his pension investments. So for those of you who might not be able to read it, it says, "I should have computed the historic covariances of the asset classes and drawn an efficient frontier. Instead, I split my contributions 50-50 between bonds and equities." Any guesses for that one? Warren Buffett's a good guess, but no. Harry Markowitz, we have a winner. You ever seen my slides yet? No. Okay. Prize for you. So Harry Markowitz, founder of modern portfolio theory, Nobel laureate, showing that simple mental shortcuts aren't just an issue for members, they apply to the most sophisticated of financial decision makers also. What about this one, Nidhi? You know this one? This is a psychologist who was asked about how do you overcome behavioural biases. And he said, it's not a case of read this book and then you'll think differently. I've written this book and I don't think differently.
Well, the first one was a guess, but I know the answer to this one.
Oh, you do? Okay, just pause. Yeah, okay. Anyone else? Okay, Nidhi, who is it?
Oh, was it Kahneman?
It is. It's Daniel Kahneman. There he is. So another Nobel laureate, won the Nobel Prize for Economics 2002, I think, from memory. His life's work is really around decision theory and won a Nobel Prize largely for prospect theory around loss aversion. And the book he's referring to there was Thinking Fast and Slow, I think, so definitely worth a read for anyone interested in this field. But if he can't overcome this sort of stuff, then really it is going to apply to all of us. And finally, this will be a challenge for you, Nidhi. This one's less well known. In fact, I thought this was my quote until I discovered someone had said it before me. Overconfidence is a very serious problem. If you don't think it affects you, that's probably because you're overconfident. Guesses for that one? You. Yeah, that's right. I'm going to change the picture on this one at the end of the session. Nidhi?
Well, you're succumbing to your own behavioural bias. You've made me the benchmark, and you're obsessed with the benchmark.
I think you've outperformed so far.
I don't know the answer to that one.
Yeah, that's right. I think this guy's a bit less well known. He's Carl Richards, who is an educator and advisor out of the US. I'll change the picture on this one for my next presentation. Okay, so returning then to the main flow of this session. So we've just looked at the biases. Now, the question is, does it really matter? Is there a need for change? Now, in the interest of time, I'm not going to go through all of this, but in the paper I go through each of those boxes on the to articulate the need for change. Effectively, these are themes that you would have heard elsewhere in the conference anyway. A lot of this sort of stuff, the ideas around demographic change, about disruption. But underlying each of them, there's a behavioural theme. Demographic change leads to changes in the way we think about things. It leads to cognitive decline, some complexity, for example. Regulators are looking at some of this sort of stuff and thinking about how they use behavioural biases in the way that they regulate. So I won't go through all that, but let me just touch on one which I think is a big one, which is cost. What is the cost of this stuff? Now, the difficulty, I guess, we have is that the cost is not as explicit as some other costs. You can't measure it as easily as you can a return versus benchmark or an indirect cost ratio or whatever it is you want to measure. And as Nidhi pointed out, the fact that you can't necessarily measure it as easily doesn't mean to say it's not real. So what I tend to do in some of the workshops that I run is actually just connect the dots between the psychology to the behaviour, from the behaviour to the financial consequence. And it's actually not that difficult to join those dots and say, for example, how overconfident are we, therefore how much overtrading might we do, and what's the consequence for alpha, or what's the consequence for after-tax returns. And when you do that, often these things come out as being an individual bias for an individual fund is costing tens of millions of dollars per annum. Now, how do you get to such large numbers? Often it's because the behavioural bias is actually quite a big distortion. If it's 20, 30, 40% of a deviation in behaviour between what we should be doing and what we're actually doing, then even if you can change the dial by 10%, you end up with big dollar values attached to some of this sort of stuff. Now, that's a per annum. Now, of course, as we know, we're in a long-term industry where per annum numbers stack up. So the financial consequences for us as an industry and for our members is really quite substantial. So if the need for change is compelling, are we going to change? Now, this one I'm less confident on because there are some significant barriers to change that we need to deal with. One is overconfidence, which I've already touched on, which is the idea that this stuff doesn't apply to me. There's no need for me to change. This is somebody else that you're talking about. I think that one can be overcome, and there's some strategies to do it, but I certainly think that's a barrier to just getting some of these sort of things recognised as being important issues. The second one down there in the corner, failure to learn. It sort of sounds a bit like you're the dunce at school, which is not the intention here. There's a lot of obviously smart people in the industry. But failure to learn here recognises the fact that actually for us to learn and to understand things and to change our behaviour, a few preconditions need to be put in place. And one of them is getting good feedback. Now, in preparing for this session, I spoke to my father, who is both a retiree. In fact, he's a retired academic in the field of psychology, so he sort of understands some of this sort of stuff. But he's also an avid lawn bowler. And he said to me, "Simon, lawn bowling is a game of correction. You bowl your first one down, you watch the path that it takes as it bends out wide and comes back around. And then you judge where it's ended up, and you make sure that your second one, you make it a bit narrower or a little bit faster so you get a little bit closer to the kitty." Now, in our industry, we have difficulty doing that. Lawn bowler can learn. We struggle because we make a decision. The ultimate outcome, whether it was a good one or not, is going to take a very, very long time in many cases for us to understand. Even when we get down there, if it's a good outcome, if it's a bad outcome, it doesn't necessarily tell us it was a good decision. A whole bunch of things could have intervened to mean that the outcome doesn't necessarily indicate successful decision making. So there's a substantial gap there in the failure to learn. And on top of that is consistency. And then again, Nidhi mentioned some of this sort of stuff as well. The idea here is not only do we have a behavioural bias towards consistency, but there's a whole bunch of things that actually are rational reasons why we want to keep doing the stuff we're doing. It's careers, it's business models, it's value propositions, it's my sense of self-identity, each of which potentially can be challenged by saying you are potentially biased in these ways, you're potentially not acting fully rationally. So substantial barriers, but what are some of the solutions? Now, I don't think there is a golden rule, a single solution to all this sort of stuff, but I do think there are some key principles that have some general applicability across businesses. Now, I think, how are we doing for time? Want to talk about 1 minute? All right. In that case, I will just touch on this very briefly. So, starting with awareness, my experience has been that some people are all over this sort of stuff. They've read every book they can find and they talk the talk. I'm presuming they walk the walk as well. David Neal, I think, was a good example. Listening to him from the Future Fund speak yesterday, he's talking about some of these issues and how it works in their business. So if he's at this end, I also see people at the other end for whom this is really quite foreign and new, and there's a bunch of people in the middle. So I think awareness, lifting the dial on awareness is a good starting point, but as Daniel Kahneman said, awareness is not sufficient. I'll just touch on a couple of ones at the bottom down there as well around leadership. So for this, I think there's going to be some really strong leadership required to overcome these sorts of effects. It has to be a leader who is courageous enough to challenge some of the existing ways of doing things, but also somebody who's got, I guess, the humility to recognise the frailties of their own decision-making and the sort of emotional intelligence to engage with others around them. So it's going to take strong leadership. And I think there's a big role for governance as well. I share the view of David Neal the other day, who said that really if trustee boards start asking these questions, there'll be a cascade effect. It will cascade into the senior management team, it will cascade to the investment team, it will cascade to the fund managers, ultimately, hopefully, cascade into the corporate world where some of these sorts of things apply for CEOs and CFOs as well. So my view is, if we want to have a world-class pension system, if we want to thrive as individuals and as an industry, these are the sorts of things that we need to be focused on. And these will allow us to take, as the lawn bowler does, take a view of our objective and then adjust for our behavioural bias, to aim for where we want to go and adjust from good to great. On that note, I will hand it back to you, Sam.